Welcome! In this tutorial, we'll cover step 1 of the deal inputs page, which includes the deal details, income snapshot, and seller financial sections. These sections can be completed in mere minutes, depending on how deep you go in the analysis. SpeedAlyzer has 3 analysis modes: high speed, assist, and deep modes. You can use them individually or in any combination, depending on how detailed you want to get and how quickly you need to analyze a property. For this tutorial, we'll be using high speed mode, and we'll point out any assist or deep mode tools as we go. And don't worry, these modes will become self-explanatory as you see them in action. For the sake of time, I've pre-completed this section. Since SpeedAlyzer can handle both self-storage and multi-family deals, we'll review the differences and share some tips along the way. So let's dive in. At the top of the page, you'll find the returns ticker. If you're starting an analysis from scratch, the ticker will be off by default. But once you complete your projections in step 2, you can turn it on to see real-time return metrics. In this tutorial, we've already completed step 2 in advance. So let's turn on the returns ticker and preview those metrics. You can monitor key indicators like IRR, AAR, ROI, equity multiple, DSCR, and distribution waterfall details. These values update in real time as you adjust your analysis. We'll cover this in more detail in the Step 2 tutorial. Starting with the acquisition section, our first input is the seller's asking price. If the selling side didn't provide an asking price, which is sometimes common practice by brokers, leave this field blank. SpeedAlyzer can analyze commercial deals of any size. For this example, let's look at a larger deal with an asking price of $12.5 million. On a side note, if the seller's asking price is undisclosed and a broker is involved, politely inquire about a whisper price. A whisper price is an informal, non-legally binding price shared confidentially among potential buyers. Use the whisper price here if it's shared with you. Continuing on, the asset type for this property was previously selected when you first created the property on the home page from the asset type pull-down menu. Depending on your selection, the analyzer will reconfigure some of its inputs to adapt. For this tutorial, we selected multifamily, but as we encounter inputs that differ for self-storage, we will switch our selection to self-storage to demonstrate those differences. Next, select your funding method. Your 2 options are all cash and mortgage. If you are planning on borrowing money, whether from a lender, private money sources, or through seller financing to acquire this property, select mortgage. Selecting all cash will disable the bank financing and creative financing sections. However, you can still model a cash-out refinance loan in your analysis. Refinancing is covered in our Step 2 Pro Forma Projection tutorial on our iHeartCRE YouTube channel linked in the description below. Let's go ahead and select mortgage. Next, you'll input the gross square footage and the net rentable square footage. The net rentable square footage is required, so please make sure to input a value here. If gross square footage was not provided, you can input a value equal to the net rentable square footage as a placeholder. In some cases, they will be the same square footage. For this deal, I input 125,000 for gross square footage and 100,040 for net rentable square footage. For self-storage assets, SpeedAlyzer also calculates the facility's efficiency ratio, which represents the percentage of a property's total square footage that generates rental income. Let's change the asset type from multifamily to self-storage to demonstrate this calculation. SpeedAlyzer calculated an efficiency ratio of 80%, meaning 80% of the square footage generates income. At the bottom of the acquisition section, you'll see the Unit Mix Tool button. This is a deep mode tool that lets you build a detailed unit mix, rent roll, and rent growth plan. It's optional, but useful for verifying the seller's numbers. You can watch our tutorial on how to use the Unit Mix tool on our iHeartCRE YouTube channel. or by clicking the link in the video description below.
We interrupt this tutorial for an important update. For consistency, all Deep Mode tool buttons, previously labeled Unit Mix Tool, CapEx Tool, and GPR Estimator, are now pencil icons located next to the fields where they apply. These tools can also be accessed from our updated ribbon menu. Simply click on the Deal Inputs button and select any tool from the drop-down. Now back to the tutorial.
Just below the net rentable square footage field, you'll see a green check mark. This appears when the square footage entered matches the value calculated by the Unit Mix tool, confirming that the numbers reconcile.
We interrupt this tutorial again for an important update. We've made some changes to how active Deep Mode badges are displayed. Previously, the green checkmark appeared directly under the Deep Mode field. Now it's positioned on the left side, aligned with all other checkmarks on the page, and labeled Deep Mode. This consistent left side placement makes them much easier to spot at a glance. Now back to the tutorial.
Next, let's model some lender financing. In the Mortgage Details section, you can model a conventional SBA or bridge loan. To model seller financing, a loan assumption, or some creative financing, click on the Creative Financing button here or in the ribbon menu above. Activating any first-position seller financing scenario from the Creative Financing page will deactivate and replace the conventional loan on the Deal Inputs page. Let's go back to Creative Financing and deactivate seller financing. For our video tutorial on using our creative financing model, visit our iHeartCRE YouTube channel, linked in the description below. Continuing with our lender financing, it is recommended to work with a commercial loan broker for best rates and terms. For the down payment, we will use 30%. Our loan-to-value ratio will automatically calculate to 70%. For the interest rate, I clicked on the Online Rate Lookup button to view today's current rates for a commercial 30-year fixed loan from the Mortgage Calculator website. I used 7.382% and rounded to 7.38%. For amortization, we'll use 30 years. We have the option of modeling up to 10 years of an interest-only payment period. For no interest-only payments, select 0. For this deal, let's select 3 years of interest-only payments. For loan fees, let's use 1% of the loan amount. Next, you have the option to convert the loan to a bridge loan. Bridge loans provide short-term funding for properties needing significant renovations. They typically cover both the purchase price and renovation costs, with the expectation of refinancing into a long-term loan once renovations are complete and the property is stabilized. Selecting Yes will roll the renovation costs into the loan, thereby increasing both the amount to finance and the loan amount. Note that the loan-to-value, LTV, now displays as loan-to-cost, LTC, because the financing is based on the total project cost, including renovation expenses. In the top right corner of the screen, you'll see a loan summary displaying all active financing currently modeled in the analysis. In this case, a bridge loan is in place and reflected in the summary. Directly below the summary, an alert window highlights any financing-related issues or items that may require attention. Here, it's notifying us that a bridge loan is active, but no refinance has been modeled yet. Since bridge loans are short-term, the recommended action is to add a refinance scenario to the model. For a walkthrough on how to do that, check out our pro forma tutorial on the iHeartCRE YouTube channel linked in the description below. For now, let's turn off the bridge loan option and continue on. In the next section, Other Costs, we'll add estimated closing costs and a renovation budget. For closing costs, we'll use an estimate of 2% of the purchase price, which covers title and escrow fees, legal expenses, recording fees, and other transaction-related costs.
We interrupt this tutorial for an important update. In the Closing Costs section, the percentage you enter now displays its real-time dollar amount in the Deal Metrics section in the cell labeled CC. The adjacent cell labeled LF shows your loan fees. Also, make sure the returns ticker above is checked for these metrics to appear. Now back to the tutorial.
For renovation costs, there are two ways to enter your budget. To keep things quick, we'll use high-speed mode and enter an estimated $1,500,000 CapEx budget based on experience with similar properties and our business plan. Optionally, if there are repairs that don't qualify as capital expenditures, you can still use this field to include them on their own or combined with renovation costs in a single budget. Just make sure not to use the bridge loan option to fund any light repairs. For a more detailed approach, you can click the CapEx tool button. This deep mode tool lets you build a renovation and repair CapEx budget, line by line, giving you a more precise and justifiable estimate. You can watch our tutorial on the CapEx tool on the iHeartCRE YouTube channel, or by clicking the link in the video description below. Next, we have replacement reserves, also known as capital reserves. These are funds set aside for future expenses to maintain a property's value and efficiency, covering major components like roofs, driveways, or HVAC systems. This field adapts based on your selected asset type. Our asset type is currently set to multifamily, so the reserves are expressed as a price per unit value. For example, I entered $250 per unit for this multifamily deal and $128 for number of units. SpeedAlyzer multiplies the number of units by $250, resulting in annual reserves of $32,000. This value will appear on the pro forma page under the line item labeled Replacement Reserves. Let's change the asset type on the home page to self-storage and see how SpeedAlyzer adapts. The prompt for replacement reserves has now changed to a price per square foot metric, which is common for self-storage. Note that the reserves input field resets to 0 anytime you change the asset type, indicated by a red outline around the field. Let's enter a reserve of 15 cents per square foot for this self-storage example. SpeedAlyzer multiplies the net rentable square feet by 15 cents, resulting in annual reserves of $15,006, which now appears on the pro forma page under the line item labeled Replacement Reserves. With the magic of editing, I'll switch the asset type back to multifamily, and we'll continue from here. To the right of the Replacement Reserves field, there's an option to move the reserves row in the pro forma from above the net operating income, NOI, where it's treated as part of operating expenses, to below the NOI. Whether reserves are placed above or below net operating income often comes down to preference or specific accounting practices. Keep in mind that toggling this option will increase or decrease your net operating income. Currently, the reserves row is displayed below the NOI. If we uncheck the option, it will move above the NOI, placing it within our operating expenses. For this tutorial, let's keep our reserves below our net operating income. To the right of the number of units field, you'll see the Unit Mix tool button. This is the same deep mode tool we mentioned earlier when discussing net rentable square footage. It allows you to build a detailed unit mix, rent roll, and rent growth plan. While optional, it's a great way to verify the unit count. Just below the number of units field, you'll notice a green check mark. This appears when the unit count you entered matches the count calculated by the Unit Mix tool, confirming your numbers reconcile. To learn more about how to use the Unit Mix tool, check out our tutorial on the iHeartCRE YouTube channel, or click the link in the video description below. The final section in deal details is syndication. If you're not planning to syndicate this deal, you can enter zeros in this section and skip it. Otherwise, if you are syndicating, there are 3 quick inputs. First is the acquisition fee, which is calculated as a percentage of the purchase price. Let's input 1% here. Second is optional other fees, a catch-all field for any additional fees you'd like to include. You can choose to calculate this fee as a percentage of the loan amount, purchase price, or sale price. From the drop-down menu, let's select loan amount and input 1% to compensate us for the time and expertise invested in securing favorable financing terms. Finally, if you plan to collect asset management fees, enter the percentage of effective gross income you plan to collect. We'll input 2% here. Acquisition fees and other fees appear in the deal metric section and are added to the total project cost paid out at closing. The asset management fee is typically paid quarterly or annually, but it's shown as an annual total and deducted from the NOI row in the pro forma. Next, let's complete the income snapshot section. In this section, we'll set both the T12 and year 1 gross potential rents. It's important to understand that gross potential rent is the total rental income a multifamily or self-storage property could generate if all units are rented at current market rates, with no vacancy, loss to lease, or other economic losses. The gap between the GPR and the actual income collected is a key part of the value-add opportunity. Current market rents, used to calculate GPR, refer to the prevailing rental rates that landlords charge in the area. Brokers will often provide this in their offering memorandum. You can also determine market rents by comparing the property's unit mix with similar nearby properties. You should not use the seller's in-place rents for your GPR calculation, as that can underestimate the value-add potential and distort your analysis. Instead, use prevailing market rents to accurately reflect the property's income potential. Let's get started from the income snapshot section. Start by selecting your income basis. Selecting GPR $sign allows you to input gross potential rent as an annual dollar amount, like $1,542,000. Selecting PSF $sign lets you enter GPR as a monthly price per square foot rate, such as $1.30 per square foot. This monthly rate will automatically be converted into an annualized value for use in other financial tables. Both income basis options are available for multifamily and self-storage asset types. For this tutorial, we're going to input our gross potential rent as an annual value, so let's select GPR $sign from the drop-down menu. Next, we'll enter the annual gross potential rent values for the T12 and pro forma year 1 columns. Let's use high-speed mode and input our values directly into the blue fields. For the T12 GPR, let's use the broker-reported value of $1,542,000. For our pro forma year 1 GPR, let's project a value based on our business plan to increase income potential by 8% in year 1. You can either type the year 1 value directly into the blue field, or use the Y1 GPR throttle tool found next to the income snapshot to quickly apply a percentage increase to the T12 value. Let's enter 8% and click Apply. SpeedAlyzer increased the T12 by 8%, giving us a year 1 GPR of $1,665,360. For a more detailed calculation, click the GPR Estimator button to enter Deep Mode. This tool is a streamlined unit mix worksheet that helps you calculate GPR values for both the T12 and year 1 columns. To learn more about using the GPR Estimator, check out our tutorial on the iHeartCRE YouTube channel, or click the link in the video description below. Below the GPR inputs, you'll find metrics for average monthly GPR either per unit or per net rentable square foot. If you're using the PSF income basis or analyzing a self-storage asset, this metric will be calculated on a per square foot basis. Otherwise, it's calculated on a per unit basis. For the final input in the income snapshot, you'll need the seller's financials, specifically their T12, which represents the trailing 12 months of performance. If only partial year financials are provided, be sure to annualize them to estimate a full 12 months. For example, if the seller provided only 9 months of data, add up the income, Divide by 9 to get a monthly average, then multiply by 12. Enter the seller's actual rental income here. Make sure it represents a full year and includes rental income only. Other income will be entered in the next step. For this deal, the seller collected an annual rental income of $1,182,791. Let's proceed to the final section of this tutorial, seller financials. In this section, there are only 3 inputs. The rest are calculated fields, and our end goal here is to calculate the seller's net operating income, NOI. The T12 gross potential rent is automatically pulled from the income snapshot above, whether entered as an annual amount or as a price per square foot. It will always display here as an annualized value. Our first input is other income, also known as ancillary income. The seller reported other income of $84,798. SpeedAlyzer also calculated what percentage this represents of the gross potential income. In this case, 5.1%, giving you insight into how much of the income is coming from non-rental sources. Next is RUBS, which stands for Ratio Utility Billing System. This applies only to multi-family assets. If self-storage was selected from the home page, this field will be disabled. RUBS represents utility reimbursements paid by tenants, which offset part of the property's utility expenses and count as income. For this multi-family example, the seller reported $52,196 in utility reimbursements. Adding up our gross potential rent, other income and RUBS line items gives us a gross potential income, GPI, of $1,678,994. SpeedAlyzer then calculates our economic vacancy loss by subtracting the seller's actual rental income from the gross potential rent. This results in an effective gross income, EGI, of $1,319,785 and an economic vacancy rate of 23.3%. Next is the seller's total operating expenses. The seller's reported T12 expenses total $567,936. SpeedAlyzer also calculated the expense ratio, in this case 43%, showing expenses as a percentage of EGI. This ratio is critical, as it forms the foundation for your expense projections starting in year 1 and continuing through the holding period in your proforma. There's also a deep mode tool available in the proforma section that lets you enter seller-reported T12 expenses line by line and also project your forward-looking expense assumptions. This tool lets you reconcile the seller's reported expense total with your calculated total. A green check mark here confirms both expense totals reconcile. To learn more about using this deep mode expense tool, watch our tutorial on the iHeartCRE YouTube channel or click the link in the video description below. We finally arrived at the seller's net operating income, which totals $751,849. Double-check this figure against the seller's reported numbers. If it doesn't match, review your inputs for accuracy. If needed, contact the seller or broker for clarification. Once finished, your work is automatically saved. SpeedAlyzer continuously saves changes to your deal inputs in real time. All seller financial inputs entered here will appear in the T12 column of the cash flow summary on the proforma page, forming the foundation for your forward-looking projections. Well, this wraps up our tutorial on the deal inputs page of SpeedAlyzer. We trust that our streamlined entry process will accelerate your deal analysis. After all, minutes matter in real estate. Make informed decisions fast with SpeedAlyzer. To view more tutorials, visit our iHeartCRE YouTube channel and subscribe for further insights and updates.